I want you to imagine a real kitchen. Not a hypothetical, not a textbook scenario. A real kitchen in a real house in a real suburb of Columbus, Ohio on a cold Thursday morning in February of 2026. Her name is Margaret. She is 71 years old. There is a cup of coffee on the table that has gone cold because she forgot it was there. Her husband George, the man who fixed everything in that house for 43 years, the man who coached Little League until his knees gave out, the man who kept a notepad of every password they ever used taped to the inside of the junk drawer. George died 11 weeks ago. Stroke. Fast. The kind that does not give you time to say what you need to say. Margaret is now sitting at that kitchen table with a yellow notepad, a reading magnifier, and a letter from their CPA. She has read it 3 times. She cannot make herself read it a 4th time. Because what that letter is telling her, in careful, professional, apologetic language, is that the federal government of the United States is legally entitled to take approximately $80,000 from her this calendar year. Not from their estate, not from some offshore account, not from money she hid somewhere. From the same traditional IRA that George spent 31 years contributing to. The same account that was supposed to be their retirement. The account that was supposed to outlast both of them and pass something, anything to their children. And here is the part that should make every married person watching this video put down whatever they are doing and pay full attention. George and Margaret did not make mistakes. They were not reckless. They were not spendos. They did not make bad investments. George maxed out his 401k for 2 decades. Margaret worked part-time and contributed what she could. They paid off the mortgage in 2019. They drove the same Subaru for 11 years. They went to Hawaii once for their 40th anniversary and felt slightly guilty about the cost the entire time. They were, by every American middle-class standard, the model of doing it right. And now, the IRS is sitting across that kitchen table from a 71-year-old grieving widow and saying, "Your husband's 31 years of doing it right? We will take a significant portion of that now, please." That is not a glitch in the system. That is the system working exactly as it was designed. And in the next 28 minutes, I'm going to walk you through exactly how it works, who built it, and the 5 specific legal moves that could have protected Margaret and can still protect you if you act before the letter arrives. Before I take one more breath, do this right now while it is in your mind. Hit subscribe and flip the notification bell, because YouTube in 2026 has a documented suppression pattern on senior tax and legal education content. The platforms do not benefit from you knowing this. The government does not benefit from you knowing this. The only people who benefit from this video reaching married couples are the couples themselves. Every subscriber on this channel is one more family with a fighting chance. Subscribe now. We are building a private archive of legal survival tools here, and you are going to want access when the letter arrives.
Now, let me show you exactly what happened to Margaret in precise legal and tax terms, so you understand the full size of what just hit her. When George was alive, George and Margaret filed married filing jointly. Their household income in 2025 looked like this. George had a Social Security benefit of $3,200 per month. Margaret's benefit was $1,800 per month. Combined Social Security, $60,000 per year. George had a small pension from his employer, a defined benefit plan paying $20,000 annually with a 50% survivor benefit. They had a traditional IRA, mostly George's old 401k rollover, with a balance of $820,000 at the end of 2025. His required minimum distribution that year was approximately $30,000. They had a joint brokerage account at Fidelity worth $240,000, mostly index funds and dividend stocks, throwing off about $7,000 per year in qualified dividends. They had $200,000 in treasury bonds and CDs, generating about $8,000 in annual interest. Add it all up. $60,000 in Social Security, $20,000 in pension, $30,000 in RMD, $7,000 in dividends, $8,000 in interest. Total gross income as a married couple, $125,000.
Now watch how the married filing jointly tax structure protected them. As a married couple in 2025, they received a standard deduction of approximately $30,000. They received the additional age 65 plus deduction of roughly $3,000 per spouse. And they received the new senior bonus deduction created by the One Big Beautiful Bill. $6,000 for George and $6,000 for Margaret, $12,000 total. Their taxable income dropped to approximately $80,000. The married filing jointly bracket meant they paid 10% on the first chunk and 12% on the rest. Their total federal tax bill was roughly $9,500 on $125,000 of gross income, an effective rate of about 7.5%. Now, George dies in January of 2026. I want you to understand what the IRS does in the 12 months that follow, because this is where the legal trap is buried. Margaret is now a single filer. The IRS uses your filing status as of December 31st. There is a provision called qualifying surviving spouse that extends married filing jointly rates for 2 years, but only if you have a dependent child living in your home. Margaret's children are 44 and 41. They have their own families. Margaret qualifies for nothing. Single filer, immediately, the year George dies. Her 2026 income looks like this. She loses George's Social Security check. Household Social Security drops from $60,000 to $36,000 per year. The pension survivor benefit kicks in at 50%, so the $20,000 pension becomes $10,000. The traditional IRA still has a balance near $800,000. Her RMD as the surviving spouse and sole beneficiary is approximately $29,000. The brokerage still pays $7,000 in dividends. The bonds and CDs still pay $8,000 in interest. Add it up. $36,000 plus $10,000 plus $29,000 plus $7,000 plus $8,000. Margaret's gross income is $90,000. Her gross income dropped by $45,000 from when George was alive. She is poor. She lost her husband. She is grieving. Her income fell by 28%. Now watch what the IRS does. As a single filer in 2026, Margaret's standard deduction is cut in half, approximately $15,750. She keeps the age 65 plus add-on for single filers, roughly $2,000. She keeps her half of the senior bonus deduction, $6,000. Her taxable income is now approximately $66,250. The 12% bracket for a single filer in 2026 ends at approximately $48,400. Margaret is above that line. She is now paying 22% on every dollar between $48,400 and $66,200. But that is just the beginning. Her provisional income, adjusted gross income plus half of Social Security, is now high enough that 85% of her Social Security benefit is fully taxable. The threshold for a single filer is $25,000. She blew past it. That means an additional $30,600 of her Social Security benefit is now added to her taxable income. Layer the bracket collapse. Layer the Social Security inclusion. Layer the RMD she cannot control, and Margaret's total federal tax liability for 2026 lands at approximately $19,000. Add the Medicare IRMAA surcharge, because her modified adjusted gross income now lands her in the first IRMAA bracket for a single filer, which begins much lower than the married couple threshold. Her Medicare Part B premium jumps from the standard $185 per month to approximately $260 per month. Her Part D drug coverage gets hit with an additional surcharge. That is over $900 per year in additional Medicare premiums. Every year, for the rest of her life, because she had the legal misfortune of becoming a widow. George died. Her income dropped by $35,000. And her total tax burden, federal income tax plus Medicare surcharges plus the Social Security inclusion penalty, is now more than double what it was when George was alive. That is the IRS death tax. That is what happens to the surviving spouse of a middle-class American retiree when the default settings of the tax code are never adjusted. And it was not an accident. Pause this video right now
And do one thing before you continue. Go to the comment section. Tell me honestly, have you and your spouse ever sat down and actually modeled what your tax situation looks like the year after one of you dies? Have you ever looked at the single filer brackets side by side with the married filing jointly brackets and done the math? I am going to guess that 90% of you have not. Not because you are not smart, because nobody told you to. Nobody sat you down and said, this calculation, this specific model could be worth 6 figures to whichever one of you survives the other. Tell me your state. Tell me roughly what is in the traditional IRA. Tell me whether the pension has a survivor benefit. Drop it in the comments below. I read every single one and we will work through it together. Now, let me explain the 3 legal mechanisms behind this trap, because Margaret's story is just the surface. Underneath it are 3 specific laws working in sequence, and most tax preparers only ever see the first one. Legal trap number 1, the bracket collapse. The tax brackets for a single filer in 2026, even after the one big beautiful bill made permanent the lower bracket structure, are mathematically half the width of the married filing jointly brackets at almost every level. Look at the 22% bracket. For a married filing jointly couple, it runs from approximately $94,000 up to $201,000. That is $107,000 of bracket width. For a single filer, the 22% bracket runs from approximately $48,000 to approximately $93,000. That is $45,000 of bracket width. The single filer's bracket is less than half the width. At the 24% line, same story. At the 32% line, same story. The entire bracket architecture is built around couples. The moment one of them dies, the survivor falls through a structural trapdoor built into federal law. Legal trap number 2, the RMD forced income. The required minimum distribution from a traditional IRA or 401k does not care about your grief. It does not care that your income dropped. It does not care that you only need $12,000 a month to live on. The IRS Uniform Lifetime Table dictates a minimum percentage of your account balance that must come out every single year as taxable ordinary income. At age 73, the divisor is approximately 26.5. By age 78, it drops to approximately 20.3. By age 85, it drops to approximately 14.8. That means by her mid-80s, Margaret will be forced to withdraw approximately 6 to 7% of her entire remaining IRA balance every single year, as ordinary income, taxed at the single filer rate, whether she needs the money or not. The forced withdrawal mechanism plus the narrowed single filer bracket equals a compounding tax burden that grows every year for the rest of the surviving spouse's life. Legal trap number 3, the IRMAA 2-year time bomb. Medicare's income-related monthly adjustment amount is based on your income from 2 years prior. Your 2026 income determines your 2028 Medicare premiums. Your 2027 income determines your 2029 Medicare premiums. This 2-year delay is the cruelest part of the trap. If Margaret does a Roth conversion in 2027, which is exactly the right legal move to make, she will not see the IRMAA penalty from that conversion until her 2029 Medicare premium statement arrives, 2 years later, when she has long since forgotten the connection between cause and effect. The system is engineered with delay mechanisms, so the surviving spouse cannot connect what she did with what it cost her. That is not a design flaw. That is intentional architecture.
Now let me tell you who built this. The Joint Committee on Taxation has had detailed actuarial models of the widow's penalty since the 1980s. It has been documented in Brookings Institution research papers. It has been written about by the American Enterprise Institute. The Tax Policy Center has published analyses. The information has sat in plain sight in Washington for 40 years. Every Congress that has had the opportunity to equalize the single filer and married filer bracket widths has declined to do so. Why? Because the widow's penalty is one of the largest sources of what tax scholars call stealth revenue in the entire federal tax structure. There were approximately 800,000 new widows and widowers in the United States every year. The average surviving spouse of a retiree carries a traditional IRA balance somewhere between $250,000 and $1.5 million. The marginal tax rate jump from the bracket collapse alone, multiplied across that population, generates
billions of dollars annually in federal revenue that never gets a line item in any budget debate. The IRS calls it revenue. You and I call it confiscation from the grieving. Send this video right now to a married couple you care about. Pull out your phone, hit share. Send it to one couple, today, not tomorrow. Because a 30-minute conversation between two spouses who are both still alive and both still healthy is worth more than any amount of money they could spend on financial planning. One conversation tonight saves the surviving spouse somewhere between $50,000 and $150,000 over the next decade. The math we just did with Margaret proves it. The cost of watching this video and sharing it is zero. The cost of not watching it and not sharing it is 6 figures and a lifetime of unnecessary tax payments by a grieving widow who did nothing wrong. Send the video. Protect the spouse.
Now let me give you the 5 legal moves that Margaret needed to make before George died. These moves are available to every married couple right now using existing provisions inside the tax code. Not loopholes, not gray areas, legal mechanisms that Congress put there specifically because they knew the trap existed and gave you the escape hatches inside the same legislation. Legal move number 1. Roth conversions during the married window. Every dollar sitting in a traditional IRA or traditional 401k is a dollar the IRS has not yet taxed. They are letting it compound because they collect a percentage of a larger pile later at the rate that applies to your filing status at the time of withdrawal. When the first spouse dies, every remaining traditional IRA dollar comes out at the single filer rate. The move is to systematically convert traditional IRA dollars to Roth while both spouses are alive and filing married jointly. While married, you can fill the 22% bracket all the way to $201,000 of taxable income. You can convert $100,000 from traditional to Roth in a single year, pay the tax now at 22%, and permanently eliminate that dollar from future RMD calculations, future single filer bracket exposure, and future IRMAA calculations. Roth IRAs have no required minimum distributions. Roth withdrawals do not count toward MAGI for Social Security taxation or IRMAA. And Roth accounts pass to the surviving spouse completely tax-free with no forced income attached. If George and Margaret had converted $400,000 of their $820,000 traditional IRA to Roth over 6 years, paying the tax at the 22% rate while married, the surviving spouse would inherit $400,000 in Roth, which generates no taxable income whatsoever. The RMD on the remaining $400,000 would be half of what it is now. The IRMAA exposure would be eliminated or dramatically reduced. And Margaret's effective tax rate in widowhood would be in the single digits instead of the low 20s. The Roth conversion window while married filing jointly is the single most powerful tax protection tool available to middle-class American retirees. Most of them never use it because nobody tells them it exists.
Legal move number 2. Step up in basis on the taxable brokerage. Internal Revenue Code Section 1014 is one of the most valuable provisions in the entire tax code for surviving spouses, and one of the most misunderstood. When a spouse dies and leaves appreciated assets to the survivor, the cost basis of those assets resets to the fair market value on the date of death. All the embedded capital gain, every dollar of appreciation from the date of purchase to the date of death, is legally forgiven by the federal government. If George bought $200,000 of an index fund in 2008 and it was worth $540,000 when he died in 2026, Margaret inherits the fund with a fresh cost basis of $540,000. She can sell it the day after the funeral. Zero capital gains tax. $340,000 of embedded gain? Gone. Legally, under federal law. But this only works if the assets are titled correctly. In a non-community property state, and Ohio, where George and Margaret live, is not a community property state, a jointly held brokerage account only receives a 50% step-up. The half that George owned gets the reset. The half in Margaret's name retains the original purchase cost. The strategy is to ensure that appreciated assets in the brokerage account are titled in the name of the spouse who is more likely to die first, or held inside a joint revocable trust structured to maximize the step-up. In community property states,
California, Texas, Arizona, Nevada, and a few others, jointly held community property receives a full 100% step up for both halves. If you live in one of those states, confirm your account is titled as community property with rights of survivorship. The wrong title on a brokerage account is a silent tax bill waiting to arrive. The right title costs nothing to establish and can save the surviving spouse tens of thousands of dollars in capital gains tax. Legal move number 3. The pension election you cannot undo. Most employer pension plans default to what is called a single life annuity. The highest monthly payment while the retiree is alive, 0 payment after death. The non-retiring spouse is legally required to sign a notarized waiver to elect single life on a qualified pension plan. Millions of American couples sign that waiver without fully understanding that they are legally surrendering their survivor's income stream. The joint and survivor election pays a smaller monthly amount while both spouses are alive, typically between 5 and 15% less, but continues paying at 50, 75, or 100% to the surviving spouse for the rest of her life. For George and Margaret, the 50% survivor benefit was a good outcome. George's $20,000 pension became $10,000 for Margaret. But for couples where the retiring spouse elected single life for the higher monthly payment, the death of that spouse leaves the survivor with 0 pension income and 0 legal recourse after the election is locked in. If you are not yet retired and your pension election has not been made, elect the highest survivor percentage you can afford. The difference in monthly payments is almost always worth less than the income security it provides the survivor. If you are already locked into single life and cannot reverse the election, pension maximization using a guaranteed universal life insurance policy on the pensioner's life is the legal alternative. The pensioner takes the higher single life payment, uses the difference to fund a death benefit policy, and when the pensioner dies, the surviving spouse receives a tax-free lump sum under Internal Revenue Code Section 101A that replaces the lost pension stream. Tax-free, no RMD, no IRMAA, no bracket exposure.
Legal move number 4. Restructure the CD and bond income. Most retirement-age couples hold between $50,000 and $300,000 in certificates of deposit, treasury bonds, or money market accounts, generating ordinary interest income. That interest is taxable at the federal level every year it is earned. While both spouses are alive, that interest is absorbed inside the wider married filing jointly brackets. The day one spouse dies, the same interest pushes the survivor into a narrower single filer bracket and may trigger an IRMAA tier. The legal fix is to move that income into tax-advantaged structures before the first spouse dies. Option 1. Replace CDs with investment-grade municipal bonds from your home state. Interest from in-state municipal bonds is exempt from federal income tax under Internal Revenue Code Section 103A and exempt from state income tax in most states. A 4% municipal bond yield in a 22% federal bracket is the equivalent of a 5.1% taxable yield. In California, a high-income tax state, the equivalence is even higher. Option 2. Shift cash reserves into a multi-year guaranteed annuity, an MYGA, which compounds tax deferred. The interest does not appear on a 1099 each year. It accrues inside the tax wrapper. The surviving spouse can access it strategically in low income years to stay under bracket and IRMAA thresholds. Option 3. Use properly structured cash value life insurance, a modified endowment contract, or an indexed universal life policy. Growth inside the policy is tax deferred. Withdrawals up to basis are tax-free. Any death benefit pays to the surviving spouse income tax-free under IRC Section 101A. Legal move number 5, the qualified charitable distribution from the IRA. This is the move most surviving spouses with charitable intentions completely miss. Internal Revenue Code Section 408D8 allows anyone over age 70 and a half to direct up to $100,000 per year from a traditional IRA directly to a qualified charity. That distribution counts toward the required minimum distribution for the year, but it never enters the survivor's adjusted gross income. It satisfies the RMD, it removes income from the MAGI calculation, it reduces Social Security taxation, it reduces IRMAA exposure, and it accomplishes whatever charitable goals the surviving spouse already had.
If Margaret had already planned to donate $15,000 to a church or her grandchildren's school, doing it through a qualified charitable distribution from the IRA instead of writing a personal check costs her nothing extra. It saves her between $3,000 and $4,000 in federal taxes on that same $15,000. The QCD is the most underused legal tool in the surviving spouse's tax plan. It is available every year for the rest of her life.
Now let me tell you what Margaret's tax situation looks like if all 5 of these moves had been executed in the 6 years before George died. The traditional IRA was 50% converted to Roth. Her RMD is now on a $400,000 balance instead of $820,000. Her forced income drops by approximately $14,000 per year. The bracket exposure drops dramatically. The taxable brokerage was retitled in George's name alone. The full step-up in basis applies on his death. Margaret inherits $540,000 of stock with 0 embedded capital gain. She can rebalance, sell, or hold with no tax consequence. The pension was elected as joint and survivor at 100%. She receives the full $20,000 per year for the rest of her life instead of $10,000. The CDs were replaced with Ohio municipal bonds. $8,000 of ordinary interest income is now federal and state tax-free. She directs $15,000 per year from the IRA to her church as a qualified charitable distribution. That satisfies half her RMD, removes it from Magi entirely, and is the same donation she would have made anyway. Margaret's 2026 tax situation in this scenario looks like this. Gross income drops meaningfully. Taxable income stays well under the IRMAA threshold. Social Security is partially sheltered. Medicare premiums stay at the standard rate. Total federal tax bill, approximately $7,000. Versus the $19,000 plus $900 in IRMAA penalties she's actually paying in the scenario where none of these moves were made. $12,000 per year difference. Multiplied across a 20-year survival, $240,000 of George's life work preserved for Margaret, for their children, for their grandchildren. That is not a financial planning pitch. That is federal tax law working in your favor instead of against you, because someone bothered to read the escape hatches inside the same code that contains the trap. Here is your final warning, and I need you to hear this carefully. The window to execute these moves requires both spouses to be alive, legally competent, and in insurable health. Roth conversions ideally happen over 5 to 7 years to avoid spiking your own IRMAA in any single year. The pension election is locked the moment you start drawing. It cannot be reversed. Life insurance underwriting requires the insured spouse to be medically insurable. If the diagnosis has already arrived, the policy cannot be issued. Trust restructuring for brokerage titling requires both spouses to have legal capacity to sign documents. If you are watching this and one of you is already in declining health, some of these tools are off the table. Not all of them, but some. The IRS is not waiting. The IRS has built the trap, set the calendar, and is waiting for the 800,000 new widows and widowers who will fall into it in the United States this year alone. The default settings of the American retirement system, traditional IRA, joint brokerage, single life pension, CDs, are calibrated for maximum government revenue on the death of the first spouse, not for surviving spouse protection. The tools to change those settings exist right now inside the tax code. They cost nothing to execute except time, planning, and a professional who actually understands the widow's penalty, not a generic plan manager with a product to sell. A fee-only fiduciary, a tax attorney who works with retirees, someone whose legal obligation is to you, not to a commission schedule. Tonight, after dinner, or right now if you were watching this alone, open a notebook. Write down 5 things. 1. The balance of your traditional IRA or 401k and whose name it is in. 2. Whether your pension has a survivor benefit election and what percentage you elected or will elect. 3. The title on your taxable brokerage account and what state you live in. 4. The total amount sitting in CDs, treasuries, or money market accounts. 5.
whether you have ever made a qualified charitable distribution from your IRA. That is your diagnostic. That is the field report. Bring it to a fee-only fiduciary and have the conversation that George and Margaret Neville had. If this video made you angry, good. If it scared you, good. If it gave you a plan, even better.
Do 3 things before you close this app. Hit subscribe and flip the bell. This channel is building a private archive of legal tax survival tools for American retirees, and every Thursday there is a new one. Like this video, not for me, but because every like pushes it into the feed of one more married couple who still has time to act. And share it with one married couple you love, one today. The IRS has the trap, you now have the map. Stay informed, stay protected, and for the love of everything, move those 5 assets before the letter arrives. I will see you in the next video.